So the second quarter of 2024 has been another good quarter for investors, for portfolio managers, for markets. Equity markets have continued to go up. Bond markets have struggled ever so slightly with the inflation dynamic, but broadly, clients are making money. Portfolios are going up, and that's the main story that we're looking at the moment, is the positivity continues to come forwards. Predominantly, the US has driven a lot of those gains. The US continues to be the superstar amongst developed market equities. A lot of that is coming from those 7 stocks that we constantly talk about every single quarter. The concentration in the US market continues to get more and more concentrated. What we've seen that doing is really benefiting the passive market over the active market. A lot of people continue to come out and say active investing has had its day, passive investing is taking over. What we're starting to see is that passive investment is doing so well because of that concentration. I don't think that's any surprise to anyone. That's very much been the mainstay of the second quarter. But what it has done is move the entire market higher. What we have started to see is some positivity broadening out away from the US, which is something that we've been invested to for quite some time. You started to see some positivity coming into Europe. You started to see some positivity coming into the UK, which has been really good to see. Again, a lot of this is positivity from buying American stocks, now with investors saying, well, where else can I go? Where else can I invest that's not in the US, that's maybe buying good companies at better valuations? Buying companies at lower prices that are still fantastic. And that's something we absolutely believe in. And that's something, coincidentally, which is exactly what active management is, which is looking for those really great investments, but paying a good price for them, not paying over the odds. And potentially that's where the US is going, is it's looking rather expensive, especially at that top level, those 7 stocks. So it's been a good quarter for equities. Bonds have suffered a little bit, and understandably, because you still have this inflation problem. You still have central banks promising rate cuts, but being unable to deliver them because inflation hasn't come down in the way that they thought it had. And that's predominantly been the story in Q2, in Q1, going through into last year. Obviously, we had Q4, where central banks started to promise rate cuts slightly earlier. So at the beginning of this year, we had 6 rate cuts priced. Where we stand at the end of Q2, you've largely maybe got 1 to 0 rate cuts priced. I think one of the main points that we should mention about Q2 is that the European Central Bank have cut rates by 0.25%. So we are starting to see some developed nations, some advanced economies, cutting their rates. So we are arguably in that rate cutting cycle now. So you should start to see from here the UK Central Bank, you should start to see the US Central Bank slowly starting to cut rates as we move through into the back half of the year. Especially as we move through into 2025, you're going to start seeing more of that. That, predominantly speaking, should be more positive for the bond market. Now, if we do get an economic recession and you do start to see the equity market respond negatively to the prospect of a recession, which currently isn't priced in, we see further interest in bonds, especially government bonds. So we think there's also that added insurance of owning bonds in case we hit a recession. That's not our base case, but it's absolutely something that we have to look at. It's something that we have to prepare for. Again, another main point of active management is trying to anticipate where this market might go and prepare investors for it. So one of the critical elements of doing that is diversification. You've got to have your assets, you've got to have your client's wealth spread over many different good ideas that can prepare that client's portfolio for different eventualities, not the continuation of 7 very, very good but very, very expensive stocks in the US, which is predominantly what passive investing is currently tethered to. So over the second quarter, we've done some investments. We've moved investments around the board to try and capture what we think are some really great pockets of value. We've moved a little bit out of that US mega cap 7 stocks, and we've started to buy a little bit more of the other companies within the S&P 500 that we think are going to take over the mantle. We've also moved more into US smaller companies. We see some fantastic opportunities there. that we've been buying. We're also looking at global smaller companies. Again, very much off this story that positivity is going to broaden out. It's going to broaden out away from the US into other areas of the global stock market. One of the main trades that we've done this quarter is to move into the UK meaningfully. We really see some value in the UK. We think that there are some phenomenal companies in the UK, and we think they're really priced to fail, and we don't think they're going to fail. So for us, that represents a good area to invest, to again, active management, to buy companies that we see real value in that are trading below where we think they should be. Again, for us, the UK, we really see some value there. So that's what we've been doing on the equity side. On the bond side, we've had to contend with a struggling bond market. So where do we go in the bond universe? Because it's been struggling overall. But there's been, like active management, lots of areas of opportunity underneath the surface. So again, some of the European bonds that we've been looking at are very underpriced. So again, we've been buying into those areas. One of the other diversifiers that we look at within the bond space is precious metals. So what we've been doing, again, is looking at that whole precious metals piece, not just gold. And again, I've talked about this before, but that positivity coming into the gold market, you're starting to see in Q2 that really spilling out into the silver market. You're starting to see that spilling out into the miners of gold and silver, which historically have been trading well below where we think they should be. So we've meaningfully started to buy that recently, and that has delivered some really fantastic returns in Q2. So we're really happy with, despite the fact that the bond market has remained challenged, we've been able to find investments on the periphery that have managed to dramatically outperform the wider bond market, but also deliver real investment returns to clients, because that's what we're all about. So coming back to the original point of, do we think active management has had its day? Is passive taking over? Absolutely not. I've always maintained that active management comes and goes. It's like a cycle. And we believe we're coming into an area where active management is going to start to shine. As you get stocks looking broadly expensive, perhaps in the US, it's that active management that can go in and isolate the very best companies at the very best prices and start to put those into portfolios. Or look for, within a challenged market, look for the outliers that really represent value. That's where active management really lies, and we think that we're about to move into that phase. So that's where we currently are. We think Q2's been broadly positive. Looking forwards into Q3, we think that that positivity is going to remain, but like we said, we think it's going to continue to broaden out. We do have election risks on the horizon. We do have the UK, we have a snap election in Europe, we do have the US election on the horizon. So there's lots of volatility to contend with, as well as the recession chance. So there's lots to watch out for, but we do mainly think that with central banks looking to start cutting rates rather than hiking rates, that's going to be a positive for the market, and it's going to continue to drive enthusiasm towards the stock market, towards the bond market. So we're looking positive from here.